Bloomberg FX Masterclass, brought to you by FxPro. Trade Forex like a pro.
Investors in foreign exchange need to pay special attention to what the pros call gap risk. That's when a currency starts trading significantly higher or lower than the last trade, creating a gap in price.
There's something called weekend gap risk. It happens when the foreign exchange market closes on Friday and then opens up on Sunday at a higher price. So if euro closed at 130 on Friday, opened up Sunday evening at 135, you can't trade in between 131, 132, 133.
It tends to happen more in the emerging market currencies, but it can really happen anywhere, depending on how the size of your position. It could be in the euro, and if you have a big enough position, even a small move would hurt you.
Major political or economic news, including interest rate decisions, can all create gaps, leaving investors who bet the wrong way facing losses. After a price gap appears, an online broker will execute or fill your order with the next best price.
If you're a buyer of euro, you're long euro at 140, and you don't want to risk anything more than it move below 139, and the gap is down to 137, you could get filled at 137 unless you have some very strict rules in place with your broker or bank you're dealing with about the maximum tolerance level that you're willing to accept. You have a problem.
When the client's opening a position late on a Friday, we restrict the leverage to a maximum of 1 to 100. This protects the trade when it comes to a weekend gap.
Of course, gap risk is just one example of the volatility that can make or break investors in the currency market. Thanks for watching Bloomberg FX Masterclass. I'm Carol Biaggi.
Bloomberg FX Masterclass, brought to you by FxPro. Trade Forex like a pro.